9 things to do before you close out 2023.
Brian, I am excited about this because we love a little bit of good planning that can have big effects in the future. And there's no better time to think about, okay, here we are, we're winding up, we're coming close to the end of the year. Are there things and decisions that I could be making that come tax time next year, come January of next year, I have set myself up well to move into the future?
Well, I find it interesting that most people wait until New Year's resolution time to make all their goals and plans. But the reality is if you can attack the year end, you actually get much more immediate benefits. Think about this. You might actually get lots of tax savings that when you file your taxes in April, you'll be pleasantly surprised. Also, everything that you do here in the fourth quarter could accelerate how much more money you have going towards retirement and getting your army of dollar bills to catch traction.
Now, for those of you that are brand new to the Money Guy Show, maybe you've not hung out with us, we have this little thing that we like to talk about a lot called the financial order of operations. It is a 9-step, tried and true way to walk through how to figure out what to do with your next dollar. If you want the free deliverable, you can go check it out at moneyguy.com/resources. But as we were thinking through some things and ideas you ought to be noodling on as we move towards the end of the year, we thought, man, wouldn't it be interesting if we used the financial order of operations kind of as our metric, as our rubric to walk through, okay, what are the things that I'll be thinking about? How do I make sure that nothing slips through the cracks?
Well, it makes sense because there's a better way to do money. And this is, in a lot of ways, the financial order of operations is your instruction manual on how to do money better. So I want to jump right in because you cannot talk about building wealth without first making sure you have a strong financial foundation. And the biggest part of this, under number 1, is what does your cash look like?
That's right. You got to count your cash. When you think about the financial order of operations, the very first step is deductibles covered. It's that first little bit of cash that you have to make sure you have put aside to keep your financial life out of the ditch. So if you're not paying attention to your cash levels, you're kind of losing the plot right out of the gate.
Yeah, you got to, if you think about step 1 of the financial order of operations, highest deductible covered, this is your separation from the world. This is what protects you. Just think about it as your shock absorber to life. As you hit any obstacle, you can just go over and it's going to feel soft and smooth as long as you have enough margin to get you through it. And then fast forward past highest deductibles. When you look at step 4 of the financial order of operations, this is your 3 to 6 months of living expenses.
That's exactly right. You want to make sure that no matter what unknown comes your way, you are prepared for it. But even as we move into the end of the year, and even as we think about things that could be coming up next year, maybe it's estimated tax payments, maybe it's a tax bill, maybe it's something fun, are there other upcoming expenses that you know you're going to have that you ought to be factoring in? If that's the case, you need to factor that into step 4, into that emergency reserve, to make sure that you're actually having the cash there when you need to make sure you can access it.
Now, this next part makes me excited to share because where you have your cash is actually super important these days because cash actually can generate a decent return again. Check this out. We covered this on a recent show. There's a big difference between what your brick and mortar company is doing, what your high yield savings account, and then what a money market mutual fund can do for you.
Yeah, if you think about someone who has an emergency fund of $30,000, if you have that $30,000 just sitting in your brick and mortar neighborhood savings account, it has right now probably on average a 0.4% interest rate. That's going to make you $126. That's a nice dinner. However, if you can hold your cash in an online high yield savings account that you can still link to your brick and mortar checking account, with a 4.25% interest rate, that would pay you a little over $1,270 per year. And if you can hold it in a high yield, like a Fidelity money market fund that's paying over 5%, that could be in excess of $1,500 a year of interest for doing nothing, just choosing to house your cash somewhere where you're going to get paid for holding it. So if you're not letting your cash work for you, you're missing out on free money.
Yeah, and if you're taking this for granted, you might be only getting a tenth of what you're entitled to. So don't just take for granted that, yes, I have cash reserves. Actually make your money work as hard as you do. Let's talk about number 2. How do you get that free money from your employer. How do you maximize every opportunity and every dollar that can be part of your army?
So for a number of us, if we're working for an employer and they have a 401k or a simple IRA or a 403b, they may have some sort of system set up that says, hey, if you put X dollars in, I as the employer will put in X dollars to match you. That money is free money. If it's a dollar for dollar match, you can literally think about it as 100% rate of return on your dollar. So as we move towards year end, the first question you have to ask is, did I take full advantage of the match? If my employer says, hey, if you put in 5%, I'll put in 4%, am I at least doing 5%? If I'm not, figure out how I can start doing that before I get to the end of the year.
Everyone who's actually bought our course, if you go to learn.moneyguy.com, we have the Financial Order of Operations course, and we talk about this, but this is a little known peek behind the curtain. Employee stock purchase plans we actually consider as part of step 2, especially if your employer offers a 15% discount. Huge. And a lot of times that discount is either the beginning of the quarter or end of the quarter, depending upon what the lower price of the stock is. But here's why we want to bring this up now. Usually with employee stock purchase plans, you get to enroll twice a year. And December is one of those open enrollment periods. Pay attention because it might make sense to take advantage of that free opportunity that your employer is offering.
I love it. And then the last thing is we think about moving into the end of the year. We always want to reevaluate when it comes to how I'm funding my employer contribution. Am I doing pre-tax? How I'm funding my employer-sponsored plan. Am I doing pre-tax or am I doing Roth? And just because I did one last year doesn't necessarily mean that I ought to do the same one this year. We actually have a Money Guy rule to help you walk through this. If you look at your marginal federal tax rate and your marginal state tax rate and you add them together and it's under 25%, you may want to consider contributing to Roth because that tax-free growth can be so valuable for you and you're already in a lower tax situation. If you are in that 25 to 30% range, it gets a little more nuanced based on your specific situation and your age, whether I should do pre-tax or Roth. And then once your marginal rates cross over 30% combined, you should really consider looking at pre-tax contributions because every dollar that you put in pre-tax could save you like 30 cents in taxes. It's a huge imputed rate of return. It's a really difficult benefit to walk away from.
Now, Bo just used some words to get me all excited because it just pulls upon my CPA background, like marginal tax rate. And a lot of you are like, what is that? Marginal tax rate is what the next dollar you earn, what it will be taxed at. And you can add state, if you have a state income tax, there'll be a state marginal rate. Your federal taxes will have a federal marginal rate. If you actually want a guide, we have a great resource for you. Go to moneyguy.com/resources, free for you. We have the 2023 tax guide. Go check it out.
Absolutely. So as we think about moving through year end and moving through the financial order of operations, another thing we want to make sure we pay attention to is, do we have our liabilities under control? And we're talking about liabilities here. We're specifically talking about high interest debt. Well, one of the best places for this to become obvious to us that it's going on is when we do our annual net worth statement. So if you're doing your net worth statement, you happen to have some credit card debt, maybe from holiday shopping, maybe from a big trip, maybe from something that happened earlier on in the year, and you notice that you're carrying on a balance, you should wipe that out because that is in fact compound interest working against you.
I love that we put in step 3, which is get your liabilities under control or take advantage of paying off all the high interest debt. We put net worth on here on purpose because I think it's a very valuable skill set to start preparing an annual net worth statement, even if you're underwater. I don't care if you have tons of student loan debt. I don't care if you have car debts that you're embarrassed about or credit card debt. Still start the process. I think a lot of people in their mind will think, well, I'll wait until I have some assets and I actually have a really strong net worth. No, start now because it's going to give you the navigation tools to see, hey, how well am I growing my assets? How well am I paying down my debt? And we think it's such an important thing. We have actually created a free template for you to download. If you go to moneyguy.com/resources, you can for free download a template so you can start your net worth journey.
And your future self will thank you for it because it can be so exciting because what you do is, even if you are in that position that Brian said, where you're starting negative, but you begin to see your net worth improve and you begin to see your assets increase and your liabilities decrease, it can be the fuel that keeps you motivated and moving forward on your financial journey. So one of the questions you want to ask as you're moving towards year end is, how much bad debt can I get rid of? If I have credit card debt, how do I knock that out? If I have high interest consumer debt, how can I get rid of it? If I have a high interest car loan, what do I need to do to make sure that it is not on my net worth statement next year? At the end of the year is a great time to begin evaluating.
Yeah, and a lot of you are probably going, how do you guys determine what's high interest debt, what's low interest debt? Because I know times have changed. We've had a lot of inflation. We've had the Federal Reserve raise interest rates where actually cash is paying more. We want to give you some guidelines here. If you're in your 20s, we think anything over 6% would be considered high interest debt. If you're in your 30s, anything over 5%, anybody over 40s, it's going to be 4%. Wipe out that debt while you're in that get rich phase as well as the stay wealthy phase. You've got to understand what's high interest debt versus low interest debt, so we wanted to give you some guidance on that.
All right, Brian, let's talk about the next thing that we ought to be thinking about as we move towards year end. We want to make sure that we're maximizing our tax-free money opportunities. This is step 5 of the financial order of operations, where we're talking about building up Roth dollars and building up dollars in health savings accounts.
Well, the first one we'll focus on is the health savings account because they are triple tax advantage. Remember, you get a tax deduction when you make the contribution, and most people take advantage of that one, but there's only a small select group that take it to the next level, which means that you can actually let your money grow tax deferred, and then if you pull it out for actual medical expenses, it can be pulled out completely tax free. So that's an incredible benefit, and a lot of people don't realize when you make that contribution, you can actually put in as a single individual $3,850. As a family, you can put in $7,750. This is the great thing about, you see me swiping away at here, and it's just like $7,750 is the family. Those are deductible expenses.
That's exactly right. And to be able to do that, though, you have to make sure that you are participating in a high deductible health plan. Just because you want to do an HSA doesn't necessarily mean that you should. But one of the great things about year end is most of us come through our open enrollment period at the year end. So you ought to be analyzing what type of health insurance plan makes the most sense for me. How do I know which one is the most beneficial? And you can kind of line up some health insurance costs, like what's the difference in premiums between the high deductible plan and the non-high deductible? Based on my insurance consumption, what are my out-of-pocket expenses going to be with a high deductible plan? What will it be if I do the Cadillac plan with copays? What are the employer incentives? Are they going to put money in? And then ultimately, what are the tax savings from doing the HSA? And if I can line up those 4 different variables and I can do the math on that, I can very easily determine annually which health insurance will likely make the most sense for me next year. Again, just because you did one plan last year does not mean that that's necessarily the best plan for you moving into next year.
Yeah, and let me do a PSA for all my financial mutants. I think you put a lot of pressure on yourself that you've got to always max out the high deductible health plan so you can do the HSA contributions, because you've heard us. I get all excited about the triple tax advantage. But look, I'm also realistic. In those years that you're having children or growing your family, medical expenses might be, and you know they're coming, they're going to be large. It's okay if you take advantage of the open enrollment ability to change from Cadillac insurance or just traditional insurance with a copay versus jumping into the high deductible, where essentially you're not really getting a lot of coverage. You're getting just what happens if I really have a medical thing that it limits your out-of-pocket limits, but it also gives you discounts on all your coverage. There's nothing wrong with looking at your specific needs and maximizing the opportunity.
Okay, so health savings accounts, that's one way to build tax-free dollars. But another way that you can build tax-free dollars is actually through Roth IRAs. And a great assessment that you can do at the end of the year is, okay, where am I from an income standpoint? Am I actually going to be eligible to put money into a Roth IRA? And as a reminder, for folks under 50 in 2023, you can do $6,500 into a Roth. And for folks over 50, you can do an extra $1,000 for $7,500. But only certain individuals with certain income levels can contribute. Once you are at $218,000 of modified adjusted gross income for couples or $138,000 for single individuals, you begin to phase out of your ability to do direct Roth contributions. So it's also a really good time to say, okay, I put money into a Roth this year, but I got a bonus that I didn't expect, or my commissions were higher, or I had a better year than I anticipated. If that's the case, you're certainly going to want to try to undo those contributions before you file your tax return next year, because man, is it a lot easier to do it before your taxes have actually been filed.
I do want to tweak one quick thing. It's also people who turn 50.
Oh,
so
yeah, that's
anybody who's born, it's not 50, it's not over 50. It's actually turning. I resemble this, so I'm very sensitive to all my fellow 1973 babies out there. Get excited. It's catch-up contribution time. So that's one of those things to pay attention to. But last thing, Bo, just to kind of close this out. There are some of you got so excited about us talking about Roth contributions that you directly contributed, and then what do you know? You got promoted, you got a bonus, your income was higher than those thresholds that Bo shared. This is the time, unwind that, because it's going to be much easier to unwind it before the tax year closes, before all those statements and things are reported to the IRS or go out. It's much easier to fix it right now.
But even if you are over that income limit, you still may be able to do backdoor Roth contributions. So there are even ways for higher income individuals, if you have the appropriate account set up, that you can still get Roth dollars growing. And we love, love, love tax-free growth. So make sure that you're not missing this step of the financial order of operations. End of the year is a great time to begin thinking about it.
So in the beginning, we've kind of worked on some of the risk management stuff with the cash, getting your debt taken care of, getting that free money from your employer. We even started focusing on the Roth with step 5 and the HSAs. But now step 6 of the financial order of operations allows us to focus on how do we max out our retirement accounts?
That's exactly right. It is the idea that, okay, I've been saving and I've done some of the lower level stuff. Now I've got my employer match. I did my tax-free stuff. Now I want to double back. And this year, for folks that are under 50, you can do $22,500 into a 401k, 403b, 457. If you're turning 50 in this year
or older,
you can actually do $30,000. So these are amazing opportunities to get tax incentivized growth into your retirement plan, into your army of dollar bill. So if you're not maxing those out, maybe you have a big bonus coming, maybe you have some year-end payout coming, consider upping your 401k, 403b contributions to max those out.
Yeah, and here's the thing. We're going to be doing some additional content on this. Government just came out, the IRS just asked, because a lot of you are probably getting nervous for 2024 because you knew that a lot of those catch-up, if your income was over a certain level, was going to have to go in after tax. Mm-hmm. Guess what? You're still going to be able to load up those accounts in normal tax-deductible ways. So that's a good thing that came out. But I want to talk about when you max out. Doesn't it also help out with lowering your tax bracket and potentially even helping with credits? What else could it help you with?
Yes, sure. If you are someone you're thinking, man, maybe I'm riding that cusp to where I was going to get the child tax credit, but now I'm not going to get the child tax credit, or I was going to be Roth eligible, my income was too high. Well, one of the great things you can do by utilizing pre-tax deferrals into your retirement plan is drive your income down. So you ought to at least do a very quick tax projection. There's tons of softwares out there that'll do that you say, all right, if I were to max out my 401k and I were to put it in the pre-tax side, what else might I become eligible for that I wasn't going to be eligible for otherwise? Because the time to do that is before we get to the end of the year, because once we get into January, all the contributions that flow in next year from a salary deferral standpoint count towards 2024, not 2023.
Now, I do know that it puts pressure on some of our listeners. If your income's under $100,000 or even under $80,000 of household income, when you hear us talk about maxing out, you're like, guys, look, $22,500. If I'm 50 and older, that's $30,000. I can get a 25% savings rate without being able to hit those maximums. That's okay. That still allows you to graduate to step 7 of the financial order of operations, even if you haven't maxed out those retirement $22,500 or $30,000 if you're 50 and over.
I love it. And as you move into that step 7, as you move into hyper accumulation, now you're thinking through, how do I finish the drill? If you've not hit that 25%, this is a great place to do that. Make that final push. So I've exhausted my Roth IRAs. I've exhausted my health savings accounts. Now I've maxed out my employer-sponsored plan. I got to find somewhere else to save. I got to find somewhere else to put those dollars. And the question is, okay, well, why? If I'm already doing that, why is 25% so important? It's because for folks who save 25%, when you get to financial independence, it can do something pretty remarkable for you.
Yeah, it's pretty. I love this because we even had a question on an earlier Q&A show where somebody said, where did y'all come up with 25%? We let the math dictate how things work. We know the typical saver, unfortunately, doesn't start until they're in their 30s. And if you look at our research, it shows you that 25% is the most effective way, really, for people who 30 and above to get to the path towards financial independence. Now, look, if you're a person, because I just told you, this is primarily for people who start in their 30s. So if you start in your 40s, you're going to have, as our chart shows you, if you go to moneyguy.com/resources, you're going to have to save more.
25% is a starting point there.
But the good news is, if you start saving and investing, maybe you're one of our young listeners who's 22, 23 years of age, you're making a great income and you're super excited about saving, there's potential, if you look at our chart, that you can see that 15%, 20% still creates great opportunities.
If you want to see what 25% can do for you, I'd encourage you to go out to moneyguy.com/resources, download this deliverable to see what kind of income you could replace based on saving at your age. So now, the next question people ask is, okay, but guys, I hear you. I want to hit 25%, but I've done the HSAs, I've done the Roths, I've maxed out my employer plan. What next? A lot of people are surprised to see there's nothing wrong with just opening a regular brokerage account. A regular after-tax, taxable brokerage account might be a wonderful place for you to hit that last 25% number.
Yeah, remember, it's step 7, hyperaccumulation. We really talk about the 3-bucket strategy. When we talk about the 3 buckets, we're talking about your after-tax. We talk about your tax-deferred, which is your employer match, as well as anybody who's doing contributions to retirement plans to take a deduction right now. And then we got your tax-free. That's all your Roth assets. Now, it's not uncommon, because even the financial order of operations is structured this way. You want to take advantage of all those tax-favored ways first. But you will get to a point where, especially if you're somebody who thinks you're going to retire much sooner than traditional 60, 65, or you get to a point where you're saving aggressively, but you've already maxed out all those tax-favored accounts like Bo said, there is nothing wrong with that after-tax brokerage account, because it does offer some unique benefits.
Yeah, here's one of the first benefits. There's no limit on contributions. So where Roth IRAs are capped at $6,500 or HSAs are at $7,750 or 401ks are at $22,500, you can put any amount of money that you would like into an after-tax brokerage account, and it's still tax advantage to a sense. You're not going to get a tax benefit, but if you hold the securities or the holdings or the mutual funds inside of that account long-term, they're subject to long-term capital gains rates, which are more favorable than ordinary income rates. So it's still a tax incentivized account that you can have effective growth in. It's just a little bit different than traditional retirement accounts.
Dividends are tax favored. Yep. Capital gains can be much lower if your income is below, I think, $44,000 for individuals, $89,000 for married couples. You can get the 0% tax rate. Really powerful stuff. And then, Bo, this is important because a lot of people, when you're doing your, as I said, when you retire early, that 59.5, because IRAs, you don't get access to them unless you do some annuitization or some other crazy strategies. 59.5, 401ks, but only if you've separated service while you've reached this age, 55.
That's right.
So, I mean, that's still, there are going to be people, especially if you think you're going to retire at 50, you're going to want to have access to an account. An after-tax brokerage account could be that bridge for you.
That's exactly right. It's a wonderful tool to have in your financial tool belt. But now, Brian, maybe somebody's out there and they're saying, you know what, guys, okay, I'm hearing you, and I love what you're saying, but I've already done these things. Like, I'm hitting my 25%, and I'm doing the stuff that you're talking about. What next? Well, in our opinion, this is where it starts to get really, really exciting, because as you continue to think about it, year end and decisions that you want to make before the year closes out, it is fun when you know you've done all the things that you want to be doing, that you can start focusing on what we like to call abundance goals.
Yeah, this is fun because you're really thinking about prepaid future expenses. And this is the one, you've heard us say the analogy, so a lot of you are already cueing the reindeer to go about it. We always say put your oxygen mask on, just like on the airplane. Put it on your face before you put it on your kids. Well, now when you get to step 8 of the financial order of operations, you have taken care of your financial goals first. So it's okay to think about the kids and their college savings. And guess what? There's some good news. Year-end planning-wise, a lot of states give you tax deductions for funding those 529s, and now's the appropriate time to take advantage of that.
Or maybe you've been doing that and you're thinking, you know what, I've got some big vacations I want coming up. Or maybe this is the time we want to upgrade the automobile. Or maybe we want to buy the second home. Or maybe I want to start investing in rental property. Well, year-end and step 8 is a great time to be thinking about those things. Okay, if I have the big bonus coming in, do I want to put in the swimming pool? And how much of that bonus is going to be able to put? That's a Christmas vacation reference.
We're throwing all kind of good stuff in there.
How much should I be putting aside and putting away in order to do that, in order to be able to accomplish some of these abundance goals?
Well, also use this as a moment to just kind of self-analyze, reflect on what is abundance for you, because we all know that money is not, it really is just a tool.
That's right.
And you're going to have to find out that abundance is really the intersection of having purpose with your money. So this is a great time to kind of think about what that means for you.
So then as you figure that out and as you begin rounding out through the financial order of operations, you're officially at the point where you get to choose what you want to do with your dollars. If you know you've done everything you're supposed to do the way you're supposed to, you get to choose what are the things that I want to do. And one of the things you may start doing as you begin to land this plane is you start thinking, hey, I ought to pay off some of that low interest debt. Well, the lowest interest debt I have is the 3% mortgage that I refinanced to a number of years ago. Should I consider paying this off? Well, if that's where your mindset is, step 9 of the financial order of operations is where you can begin to have the freedom to make those decisions without worrying about sacrificing other areas of your financial life.
Yeah, it is unique because we know the majority of people with mortgages right now are still some of those lower interest mortgages. But I do want to give people the understanding there's a reason this is step 9. This means you've already gone through steps 1 through 8 of building your financial foundation. So now this is moving beyond get rich activities. This is more of a stay wealthy activity, because you are minimizing risk and other things. But I want to caution people. Do know that this is something that I would love for you to focus on if you're 45 and above, because a lot of people, if you hit this too early, before you've actually saved 25% of your gross income and done all the get wealthy activities, you might be circumventing or working against your future self. Now, with that said, if you are a person that has gone through steps 1 through 8, you're 45 and older, and now it's a matter of just you want to check the box on the bucket list. I'm not going to be mad at you. Now, I will tell you, self-reflection, Bo and I have had so many debates on this. He knows I have a 2.5% mortgage. I owe less than $200,000 on a house that's worth substantially more than that. And I've had a hard time because I have enough cash I could stroke a check for it. But now I'm making 5.25 on my cash.
It's hard to walk away from it.
So here's what I'm doing. I don't mind being self-reflective to you guys. At some point, the Federal Reserve is going to cut rates again.
Sure.
When we get to the intersection point that now my cash is no longer earning what my mortgage is, I'm just going to stroke a check. That's what I've done, because I can't walk away from that 3.5% arbitrage problem I have right now.
So another thing, and we love this one, we saved it for the end of the show, but it should not be the end of your thought process. So in our opinion, this should be the beginning of your thought process, because we actually, when we walked through the financial order of operations course, we consider there to be some ground rules, some step zeros that you ought to think about. Well, generosity is one of those. And we think that the end of the year, as we move into the holiday season, this is a great time to begin reflecting on that, both from the grander sense of what you are doing and why you are doing it, even to the more granular financial sense, because there are some financial planning items you can do as it relates to generosity, as it relates to charitable giving. A big one is, hey, should I be using a charitable giving fund? The markets have done well this year. They've done well the past couple of years that I've been investing, and I have some really highly appreciated securities. Instead of me making year-end contributions to some of the organizations and entities that I support, maybe I should gift appreciated securities. That's a great, super tax efficient thing that you can begin looking at the end of the year.
Yeah, we love charitable gift funds because they really do create a win-win situation, because not only do you get to make and honor what your heart wants you to do to be generous, and you get a tax deduction for it for the value, the fair market value of those. But the organization receives the full benefit, but nobody actually had to pay the income taxes on that appreciation. It works out really well. And I think you said it, but I want to echo it, Bo. We put this at the end of step 9, but I think every time we talk about the financial order of operations, if you look in our course, if you look at my upcoming book, this is a ground rule. This is something that I would consider a step 0. I want you to be generous in all facets of your life. If you don't have resources or cash yet because you're just in the beginning phase, there is nothing wrong with you also focusing on your time. But here's another thing, because we always want to bring this back to what the topic today is. What are the fourth quarter things as you're landing and closing out this year to maximize? Why not also just go see what you're not using and see if you can donate it? It is such an easy way to kind of to get a great deduction on your tax return, but also to reduce the clutter. Great time to maximize that opportunity.
I love it. There's so many things that if we can do a little bit of planning at the end of the year, if we can move a few pieces around the board at the end of the year, there's a really good chance we're going to set ourselves up for a better next year. There's a really good chance that when it's time for us to do our taxes next year, we're going to look back and say, man, I'm so glad I made that decision. I'm so glad I made that adjustment. I'm so glad that I thought through that. Because the counter to that is, oh, geez, why didn't I do that thing? Why didn't I make that play? Why didn't I max out that account? Why didn't I fund that Roth? Why didn't I fill in the blank? If you can work through some of these steps and be a little proactive in your planning, there's a really good chance it can have a huge impact down the road, and your future self will thank you.
Guys, we have loaded you up. You heard constantly free. Moneyguy.com/resources. We really do want to overwhelm you with abundance, give you all the free stuff to maximize your path to success. Now, some of you are like, wow, there's a lot of moving parts in financial decisions, and I'm good at making money, but maybe I'm not the most efficient at being a technician on these things. I would invite you, if you are at that level of success, we'd love to talk to you about fulfilling the abundance cycle and taking the relationship to the next level. We work with people all across the country. We love creating this content. This is a blast. So thanks for tuning in. I'm your host, Brian Preston, Mr. Bo Hansen. I do want to remind you, this shows like this show you can either own your financial life or your finances can own you. Money Guy team out.